Have you ever looked at a stock chart with all its spikes and dips and just thought, this is just chaos, right? A total mess. Well, what if it's not random? What if there's a story being told in those lines, and you just haven't learned the language yet? Today, we are going to crack that code, breaking down the core ideas from Adam Grimes' fantastic guide to technical trading.
So let's just jump right in. For a lot of people, and I mean a lot of people, including financial pros, a chart like this is nothing more than a high-stakes guessing game. They believe that any price move is basically random, that trying to predict it is a fool's errand. All they see is financial static.
But the big idea we're diving into today is that this isn't static at all. It's actually a signal. It's a story about this massive battle between buyers and sellers, a real-time map of human psychology. Greed, fear, hope, the whole shebang. And the best part? It's a story you can absolutely learn to read.
And that question, right there, it gets to the very heart of a huge debate that basically splits the entire financial world in two.
So in one corner, you've got the random walk theory. The idea here is that prices are just unpredictable. So your best bet is to buy a broad market index, set it, forget it, and just call it a day. But in the other corner, you have traders, and they believe that hidden inside all this price action, there are patterns, there are clues, and there's a real tangible edge for anyone who knows how to look for.
Okay, so if an edge really does exist, where in the world does it come from? Is it some, super secret algorithm, some crazy complex formula? Nope. The answer is actually way, way simpler. And honestly, it's much more powerful.
And that's it. That is the entire game right there. The author Adam Grimes literally calls this the holy grail of trading, and it all boils down to one simple concept: imbalance. It isn't magic, it's just raw pressure.
I want you to picture a giant game of tug-of-war. You've got the buyers on one side, pulling the rope up, and on the other side you have the sellers, pulling it down. Now when the buyers are pulling with more urgency, more force, well, the price has to go up. And when the sellers are yanking harder, the price has to fall. Every simple pattern you see on a chart, it's just the footprints left behind from this epic battle.
Okay, so we know this tug-of-war is happening pretty much constantly. But how do we actually see who's winning by looking at a chart? Well, for that, we can turn to a classic model called the Wyckoff market cycle. Think of it as a simple but really powerful map of the market's entire story. So, the story often starts when it seems like nothing is happening at all. This is the accumulation phase. The market is flat, it's boring, nobody's talking about it. But behind the curtain, the big, sophisticated players, what they call the smart money, they're quietly buying up everything they can, building their positions while no one else is even paying attention.
And then comes the markup. This is the explosion. This is the uptrend that everyone starts talking about, the one that makes headlines. The public finally catches on, the hype machine starts churning, and this flood of new buyers comes rushing in, pushing the price way, way up. The party is officially in full swing.
But you know what they say, every party has to end. At the very top, the market starts to move sideways again. This is the distribution phase. Now, to the average person, it just looks like the market's taking a little breather before its next big move up. But what's really happening is that the smart money that bought way back in accumulation, they're now skillfully and quietly selling everything they own to all the enthusiastic latecomers. And then the floor gives out. The markdown phase begins. This is the panic. This is the collapse. The trend breaks, margin calls kick in, and the price just tumbles. And the cycle isn't really complete until the very last of the hopefuls finally throws in the towel and gives up.
Now, this cycle we've been talking about, it's not just some abstract theory. For traders, it's a practical playbook. It helps them spot 4 fundamental types of trades.
And here's where this gets really useful. This table basically connects a specific strategy to each phase of the market cycle. So, if you think you're in that markup or markdown phase, you probably play for a trend continuation. If you think the party's over and the trend's about to reverse, you're hunting for a trend termination trade. And in those sideways zones, accumulation or distribution, you can trade the range. See? It turns the map into an actual action plan.
So you've got the map, you've got the playbook, you're all set to go, right? Well, not so fast. Here's the big twist. Knowing all of this stuff, it's only half the battle. Because the biggest, most dangerous opponent you will ever face in the market is looking right back at you in the mirror.
You see, our brains are basically running on ancient survival software.
And that software was absolutely brilliant for helping our ancestors escape saber-toothed tigers and find their next meal. But when you take that same fight-or-flight operating system and you apply it to the financial markets, it is a recipe for total disaster.
These glitches in our mental software, they're called cognitive biases. And they are these predictable, consistent errors in our thinking that make our natural gut reactions, well, often the exact opposite of what we should be doing to actually make money.
And this slide is a perfect example of how our wiring just works against us. We are psychologically hardwired to snatch a small certain profit because, hey, it feels safe. But at the same time, we'll hold on to a massive losing trade just hoping and praying it'll come back, all to avoid the pain of taking a small, definite loss. It's exactly why so many people do the complete opposite of that famous trading rule: cut your losses short and let your winners run.
And you want to know what makes all of this so maddening? It's that the market is a terrible, terrible teacher. Because there's always an element of randomness, you can make a brilliant, well-researched trade and still lose money. And even worse, you can make a totally reckless, horrible decision and get lucky. This random reinforcement makes it incredibly hard to learn the right lessons and way too easy to learn all the wrong ones.
So after all that, after going through the cycles, the strategies, and the psychology, what's the one crucial message you should walk away with?
Okay, here it is in a nutshell. First, a chart is not just random noise. It is a story about the human tug-of-war between buyers and sellers. Second, the entire goal of technical analysis is just to learn how to read that story of imbalance. And maybe most important of all, true success isn't just about reading the market. It's about reading yourself and mastering your own psychological flaws.
When you think about it this way, it changes everything. The market stops being a casino, and it becomes this fascinating puzzle of mass psychology. So the next time you look at a chart, don't just see a jagged line. Ask yourself, what's the story here? And who's winning the fight?